Auditors are paid by their clients, but their responsibility is to the public, investors, creditors, and others who rely on financial statements. That is why AICPA Rule 101 independence exists. It protects the public's trust, defines the situations when independence is required, who must be independent, and what relationships and services are prohibited. The AICPA Rules of Conduct establish ethical expectations for CPAs in public practice. Among all the rules, independence is one of the most important rules because it directly affects the credibility of audit and attestation services. And independence is what makes the CPA's opinion of the audited financial statements meaningful. A common misconception is that CPAs must always be independent. Independence is required only for certain engagements, primarily audits, reviews, and attestation services. For tax and consulting work, independence is not required, although objectivity and integrity are still expected. AICPA Rule 101 states that a member in public practice shall be independent in the performance of professional services as required by standards. This rule sounds simple, but its application is complex. That's what we'll focus on. The interpretation of this rule, who must be independent, and what situations impair independence. Rule 101 uses the term covered member to define exactly who must be independent. This concept is critical both in practice and on the CPA exam. First, all members of the attest engagement team are covered members. That's straightforward. If you're assigned to the audit, your independence is required. Owning stock in the client, even indirectly, would impair independence. Second, anyone who can influence engagement is a covered member. For example, suppose a member in another office isn't assigned to the audit, but reviews the work papers or provides consultation on a complex accounting issue. That partner is a covered member. Independence applies. Third, Rule 101 includes the 10-hour rule. If a partner or manager provides more than 10 hours of non-attest services to an attest client during the year, they may become a covered member, even if they never work on the audit itself. Fourth, the firm itself is always a covered member. This includes firm-sponsored retirement plans. For example, if a firm's pension plan holds stock in an audit client, independence is impaired, even if no individual auditor owns the stock personally. Now, on the CPA exam, when you see the term covered member, assume the rules are being applied broadly. If someone has influence, authority, or involvement, independence is likely required unless a clear exception applies. Prohibited relationships in terms of an auditor's independence are financial and personal relationships that could compromise the auditor's objectivity or create a conflict of interest. Rule 101 distinguishes between direct and material indirect financial relationships. Think of direct financial relationships as a no-fly zone. If you own stock in the company you're auditing, you're too close to the action, like a fan trying to umpire a game for their favorite team. That's a direct conflict of interest. The result, you can't be independent. So what are indirect material financial relationships? If you own stock through a mutual fund and that stock represents a material amount of your wealth, you've crossed into risky territory. It's like owning a piece of the team but pretending you don't. Still a conflict. Although there isn't a specific definition for materiality, a common guideline is 5%. There are some exceptions, though. Some loans, like auto loans or loans secured by life insurance, don't automatically break independence, as long as the balances are under certain thresholds. Independence can also be impaired if an auditor or a member of the audit team has previously served in a managerial or influential role in the company or subsequently accepts employment with a client. For instance, let's say you're an auditor at a big firm and your partner who's also working on the engagement just got a role as a CFO at a client company. That's a red flag for independence. Your firm is no longer considered independent for that audit because of the relationship between your colleague and the client. The member's immediate family are included in the covered member rules, including spouse, spousal equivalent, or dependent, is subject to Ruling 101 and its interpretations. Imagine your spouse is the CFO of the company you're auditing. Well, in the independence world, that is a big no-no. You can't audit a company if your immediate family members, like your spouse or dependent, hold significant positions or investments with that company. It's like being the referee and having your sibling on the other team. No matter how much you want to call it down the middle, it's hard to stay impartial. And even if you are, or believe that you are, impartial, the optics of the situation are not good. That's why you have to be independent in fact and appearance. Litigation also can impair independence. It's difficult to be impartial and neutral if there's a dispute between the client and the auditor, like, for instance, the company suing the auditor for faulty work, or if you're suing the company for fraud. It's like trying to referee a game while arguing with one of the teams. Another situation might be you're auditing a company and they're threatening to sue your firm for not catching a big mistake in the financials. You can't continue working on that audit. You're too involved emotionally and your objectivity is compromised. The AICPA Code of Professional Conduct also restricts the types of non-audit services that can be provided to companies that are being audited. And the SEC is even more restrictive in terms of independence rules for audits of public companies, meaning those trading on the exchanges. The PCAOB and SEC have 9 prohibited non-attest categories of services. And this means that the audit firm cannot provide these services to the publicly traded company if they're also handling the audits. These prohibited services include bookkeeping, actuarial services, broker or dealer services, financial information system design and implementation, internal auditing outsourcing services, legal services, appraisal or valuation services, management functions or human resources, and expert services. Independence under the AICPA code is not optional. Without it, the audited financial statements lose credibility. Every rule we've discussed, financial interests, relationships, litigation, non-attest services, point to the same risk, loss of objectivity. Even small violations can undermine objectivity and public trust. In the end, independence is what makes the CPA's opinion of the financial statements meaningful.